Well, hello. Happy Tuesday, everybody. Welcome to a riveting, another Tuesday night edition of the Savvy Home Seller What the Heck's Going On in the Housing Market show. and this week we're talking mortgage interest rates. Oh my goodness, there was a lot of discussion about interest rates and mortgage. I was combing through and looking at the hot topics for the week. There's all kinds of discussion, and boy, I've got some interesting information to share with you tonight. We're going to talk about that, whether the interest rates are, if we're in store for some major changes, if things are going to be, upended for 2026, or is it going to be status quo? But I want you, if you're watching this live, sorry, not on the replay, but there is a poll. Let me know what you think. What do you think the interest rates are going to do next year? You think they're going to stay the same? You think they're going to go back up? Because we did have those interest rates come down last week. They kind of took a serious adjustment downward. And we're going to talk about why that happened. But is that going to hold? What do you guys think? What do you think is going to happen next year with interest rates? Make sure you vote on the poll. We'll make sure to get back to those poll results at the end of the show. Second order of business before we dig into things, I want to know about your wins. There's all kinds of negativity and all kinds of, it kind of blows your mind these days. Oh my goodness. You really got to look for positivity these days intentionally. My therapist and I talked about that. And so I want to hear from you guys, whether you're watching this live. We got the chat is popping, which I love. But if you're watching this on the replay, share any positivity, whether you got an offer accepted, whether you got your house finally in the market, whether you organized that catch-all drawer in your kitchen finally. That drawer that you're like, someday I'm going to organize this thing. Half of it's junk. Well, if you got to it finally, let us know. Because you know what? That's kind of stuff, that kind of, those types of updates, they're contagious. And that's a good type of contagious. Not the nasty kind. Next order of business, questions. So if you do have a question that you want to make sure that I see, make sure you put QQQ before the question in the chat. As we get rolling here, sometimes conversations, you guys are having conversations within the chat, which is fabulous. But it gets hard to pick out, and I don't want to miss out on your questions. If you guys have questions, I want to make sure I get to you guys. So we've got a lot to cover. The last thing I wanted to mention is I have been putting links to all the articles that I talk about in the description. So you feel free to kind of vet through. As you guys know, I want you guys to advocate for yourself, make your own decisions. Don't take my word for everything. Try to vet this stuff out for you guys, but I want you to read it for yourself, digest it, come to your own conclusions. So I'm going to put those articles so you know where all this information is coming from. All right, let's take a look and see who's in the chat. We got the regulars. We got MHO8 leaving town this weekend. So of course he's going to the store. And those that are here every week, you know that he likes to this is this shopping night for MHO8. Pop Hurry of Life with Laura's chiming in from New Hampshire. New Hampshire in the house. We've got Beth R in the house, and Pop Hurry of Life with Laura says, my bank here in New Hampshire said the rates will be going down. That depends on how knowledgeable your banker is. We're going to talk about that in a second. We got Nicole Olson in the house. Good to see you, my friend. Where have you been? Good to see you. We got Jonica SG from Long Island. Oh, greetings from Long Island. I cannot do a Long Island accent. I wish I could. My friend Jackie Baker, with her North Jersey accent. She's got great North Jersey, Long Island type accent. Cindy Wonder is from Eastern Oregon, all the way from other side of the country. Fantastic. And we got Karen Bowman in the house. We got a win. My purchase offer was accepted today. Inspections are tomorrow afternoon. Woohoo! Fabulous. Thank you for sharing that. That is so awesome. Congratulations. That's so good to hear. Hello. Is that like Mrs. Doubtfire? Hello. I'm baking cookies. If I give you my address here in Plymouth, send me over some. we got we got Houston in the house. We got Red from Houston, and we got Clark down in Atlanta. Oh my goodness, this is great. We got Lynn, who's almost ready to list. All right, fantastic. Hopefully September, maybe interest rates will drop. We're going to talk about it. We've got, let's see what else we got. We got that Wiggly Arm Guy. I love that handle. Hi, Jen Smallwind. Packed up up all my personal wall photos as part of a declutter pre-sale. Bigger job than I thought. You know what? You do get a round of applause for that, because that is, taking photos off the wall and packing that stuff up is that's a massive job. It's a lot bigger than you realize. So we've got Kirsten Kogan in the house with a question. Jen, love your dedication to channel, all the great advice. My husband and I, thank you very much, by the way. Appreciate that and appreciate you being here. My husband and I are actively looking to buy in Grand Rapids, Michigan. If we buy now and refinance, or wait, you know what? I'm going to put a pin in that. I'm going to put a pin in Kirsten's question. I'm going to make a note here, because we're going to come back to it. Because I think what we're going to talk about today will help provide you some information. Because when I always say, whenever I am trying to figure out a problem or answer a question, research is always the way to go. So we're going to get this party started. But as always, before we get into that, we got some breaking news. Very interesting. I thought you'd want to share this with you. Okay, so this is this actually just dropped. Oh gosh, 24 hours ago, earlier today. This is super interesting. Chicago startup says it can protect condo owners from surprise HOA costs and help sellers avoid concessions. This was super interesting, and I'm going to be following this to see how, if this is one of those, flash in the pan situations, or is it going to develop into something bigger. So it says a Chicago startup is tackling HOA fees by providing a product aimed at giving condo owners a safety net. HOA warranties. You know how they have homeowner warranties, depending on where you live. They're not such a big deal up here in the Northeast, but I know down in the southern states, central states, I know you guys do a lot of HOA, a lot of homeowner warranties, where the houses, the major appliances and mechanicals are covered for typically a year after the house is sold. So this is an HOA warranty. So it was started by a Chicago real estate agent, and he said, because he wanted to, address the uncertainty of how much money it would end up costing a condo owner when a special assessment arises. So this is coming from the perspective of somebody that's thinking about buying a condo and wanting to protect themselves from all the crazy stories that you're hearing. Now, I don't know. This is so new. We don't know. This is something that's, an existing homeowner can buy, an existing condo owner can buy, potentially, but we'll have to see. He says this tension exists in all condo and townhouse sales from the minute it gets listed to the day it closes, and where everybody, all parties are kind of collectively holding their breath. I would say that that tension exists the entire time lately, depending on where you live, what's going to happen with your HOA fees. It says there are over 370 homeowner associations in the U.S., and that represents over 53% of owner-occupied households. I know there's a lot of negative sentiment, for good reason, with HOAs last few years, and a lot of folks have it in their mindset that I'm totally going to avoid HOAs. 53%. So if you're out shopping, I want you to just keep that in the back of your mind. It's not just for It's not just for condos, it's for for new developments and single family homes. That's half. That's a lot. That is a lot. Makes it hard to avoid. So he said that this agent says he designed the HOA warranty to provide condo owners protection up to $10,000. It's no small potatoes, but it's not, not enough to cover some of the big ticket items that you're hearing in the news. It says when a special assessment is triggered during your policy period. He says that HOA warranties differ in that we cover the systems and structures that you own as part of the association that can be repaired or replaced and have a life expectancy with a reasonable time. And then they just go on, in terms of how it helps, get the house sold and so forth, which is a good thing if you're trying to overcome that obstacle with a home buyer. But what is covered? And this is the most important thing. It says the warranty differs from homeowners insurance, which pays for losses or damages to one's property if something unexpected happened. An example would be if a tree fell on a condo, that's what your condo insurance would cover. Whereas an HOA warranty, and it differs in that we cover the systems and structures that you own as a part of the association that can be repaired or replaced and have a life expectancy. The HOA warranty says it covers things that warrant a special assessment: roofs, heating, cooling, balconies, decks, elevators, garages, pools, sidewalks, security systems. He explains that warranty holders would file a claim with the HOA warranty when the order is initiated. Kind of they go through that process, and it says that once the warranty claim is approved, the payment is made as directed to the association. He says the sellers who don't want to make concessions when selling because of the uncertainty of any future special assessments can offer the warranty in lieu of giving credit or providing an escrow holdback while still addressing buyer concerns. And that's, that is if there is something, for example, if you live in an association and there is a potential, maybe it came up during a meeting, during an HOA, a board meeting, trustee meeting, that there will be a roof assessment coming, because the roofs are aging and the association has to replace them, so on and so forth. But it hasn't actually been assessed yet. So it goes on to say that it says, it's not as though you're offering it because you have a concern. It's more of offering it as an acknowledgement that, hey, you're going to be coming to this building. You're going to be handing over a large sum of money, take possession, and this will kind of help the transition. So he says the HOA warranty offers several options. A 1-year policy, $380, where the rubber meets the road. You say, how much? 1 year, $380. That's pretty good. 2 years, $600. 3-year policy, $800. A typical homeowner's policy, a homeowner warranty is, up in our area anyways, is more than $380 for a home warranty. It says each covers up to $10,000 for a one-time event. Now, this is where things are different. And again, we don't have fine print. I don't have contracts or anything that I can review. With a homeowner's, a homeowner warranty, it isn't a one-time event. It could be the air conditioning, and then maybe your heating system goes, so on and so on. Your hot water heater goes. There are certain limitations. There are sometimes deductibles, but it's not a one-time event. This, from what I'm reading, it's like a one and done type of deal. If you have one instance, then the policy's been used and that's it. It says we cover houses, townhouses, condos, anything with an association of 5 or more units. And then the HOA warranty isn't available everywhere. This is about as close to the fine print as you're going to get. Currently, it's being offered in 6 states only: Illinois, Indiana, Michigan, North Carolina, Ohio, Pennsylvania. The most important state that this could help homeowners, help sell their property: Florida. It's not in Florida. It says where condo owners are dealing with sky-high HOA fees and so on and so forth. So we will see how this unwinds. There's too many questions to make a judgment. Sounds good. sounds really, really promising. The question is, I mean, it's a brand new company. What happens if they have a whole bunch of warranty claims and where's the money coming from? I mean, if it's such a small company, it's a startup. Um, how are they covering that? If there's a ton of claims issued in a short period of time, how's that going to work? But food for thought. I thought it was super interesting and wanted to share it with you. I'm just going to jump back over in the chat. Let's see. What is going on? Oh, we got a win. Joy has a win. All right. Stain the deck. Most of the house packed. Woohoo! Fantastic. That's huge. Huge, huge, huge. Let's see. Let's see. Have you ever sold any houses on Epstein's? There we go. I'll leave it alone. Oh boy. Let's see. Wiggly Arm Guy says that seems like a quick way for this startup to go broke in this environment. Yikes. You are not kidding. And I'm with you, MH. If it sounds too good to be true, this is the thing. I thought it was interesting, but let's wait and see. Clark says they need to come to Georgia if it is worthwhile. 100%. Yeah, we'll see what happens. With that. With I thought it was. I said I've never heard such a thing, and sometimes these things are a flash in the pan because you know what? It sounds good on paper, but then the rubber meets the road. Oh man. So let's jump right into it. So this article came out yesterday. Warren Buffett's Berkshire Hathaway predicts major mortgage rate changes for 2026. The headline grabbed me, so I figured we'd talk about it and see if this is like if the article is legit. If there's anything, what are they talking about here? So it says the housing market, the beginning of the article, face persistent headwinds. When the skyrocketing inflation and recession fears doubled, mortgage rates went from 3.5 to 7%, 2022. Years later, mortgage rates have been remained stubbornly high while home prices surge. It says, although it may take longer than expected to recover, many housing experts now believe that mortgage rates will decline next year, leading to a modest market recovery in 2026. This goes against any clickbait article, any housing crash bro YouTube video that says that has been saying the house market's going to crash, and they've been talking about you can twist the data any which way you want. The experts, the economist is who I listen to, and there, this article, according to this article, they're saying leading to a modest market recovery. We'll see why. It says they released their it's real estate market forecast for Q4 2025. The firm expects the housing market to soften. I would agree with that. However, the market will likely face the same changes through the remainder of 2025. And pretty much they just said the same thing in the same line. Silly editors. It says they expect the housing market to soften, but the mortgage rates won't fall until 2026. It says many buyers have been on the sidelines. Yes, waiting for housing market conditions to improve. We know this. It says that as a result, housing sales have been muted this year, even during the typically busy spring and summer seasons. Although mortgage rates are unlikely to fall notably this year, Berkshire Hathaway Home Services expects overall market conditions to improve modestly next year. While forecasts suggest a softening housing market, most economists believe that home prices are unlikely to fall dramatically. I want to put the emphasis on the word dramatically. Instead, they expect prices to continue rising just at a slower pace. Slightly lower rates might encourage buyers to act, especially if sellers list homes to beat any potential price correction. That could ease inventory and put downward pressure on prices. That right there, that statement is probably more important than you realize, because slightly lower rates might encourage buyers to act, especially if sellers list homes to beat any potential price correction. Now, I've said this before. The biggest thing, and I've been through this scenario when it was much, much worse. Been doing this for 30 years. So I've been through the great financial crisis. I know what it looks like, I know what it feels like, and I know what happened before, during, and after. The biggest thing that you can do as a home seller now is to get ahead of whatever correction, to work with an agent that knows how to interpret your local market data. Do not rely on the articles. Do not rely on what I say for your particular area. You have to know what the median price is, with the median time to the offer, median time on the market, and then the comps. The date of the comps is so important. What am I talking about there? Well, if you're trying to price your house now, it's now August. If you're in a market where month over month, the prices have been softening, you do not want to go back too far. You want to go back maybe a month or 2 months tops. If you have to go back a couple months, before that, typically the appraisers like to use 3 months. We usually it's 3 to 6 months max in a stable market. Make sure you adjust for the time. So if you have a comp from May or even June, make sure that you take into consideration that there may be an adjustment between then and now and going forward. If the trajectory in your area is a slight slide and you want to ensure you get that house, especially now. Now, if you're in the southern states, okay, meaning like if you're in the Florida markets, seasonal markets, now you're getting into your busy season. You're about to get into your busy season. But for a lot of the rest of the country, once we approach the holidays, the market slows. Once we hit the end of October, November, it gets quiet. And what does that mean? If buyers slow down, the home prices typically slide. There's less inventory, and then it picks up when I head into the spring market. So if you are trying to get your house, and I'm having these conversations with my home sellers now that might be watching right this very minute. I think one in particular is probably, you know who you are. Hello, hello. And we're getting their house ready to go on the market. We're going to be very, very careful. Very careful, because the worst thing you could possibly do is get behind the correction. If you end up playing catch up, and I see it all the time, price drop, you're gonna be in a pickle. The article goes on to say that despite initial projections of mortgage rates inching towards 6% in 2025, rates will still hover between 6.5% and 7% by the end of the year. While there is hope for improvement for 2026, it will be moderate. It says, as for the forecast for Q4 2025, most housing experts agree that meaningful relief may not arrive until 2026 or later, as mortgage interest rates are unlikely to decline significantly. There are so many asterisks, which I'm going to talk about in a second, because, to predict, based on the data that we have now and the projection of, where the rates are, where the market is going, the demand on the market, investor confidence, what's happening in the bond market, that will be a clue. But there are some things that could happen that could derail it. Let's see. Joyce says, do you know what percentage of homes are being removed from the market from not selling for what sellers wanted? You know what? I don't have an updated percentage, Joy. I actually have, let's see. Let me look at my articles. Enjoy some music while I look at my data here. Oh my goodness. I actually, you know what, Joy? I know I pulled up some of that data today, and you know what? I don't have that information, and it does depend. Here's the thing: is national data versus local data. You got to be careful. You got to be careful. Certain areas are going to be feel it more than others. I wanted to jump back to let's see. Where are you here? Caitlin, where's your question? Caitlin. Okay. So Caitlin says about, they're actively looking to buy. And if we buy now or refinance, actually, you know what? I might want to wait a little bit longer to answer this question, only because, I have a little bit more information that might, help put some light on that. But I will tell you that, and this is not a sidestep. It's not a cop-out answer. This is not I have no idea, so I'm going to tell you this answer. This is the truth. You need to look at your own financials. You need to look at your own financials. You need to look at what is your financial situation now? What is the need now? What is the reason you're moving? Because here's the thing. If you can afford comfortably, the rate is right around a little, 6.5, 6.6 right now. If you can comfortably afford this rate and say worst case scenario, it stays the same or goes up, are you okay with that? Does it improve your life situation by moving now? If you find the right property, then I would say do it now. Why? Because when the rate drops, when you get to a certain point, typically the rule of thumb is 1%, because it does cost money to refinance. Okay. And that money to refinance, you want to look at how long it's going to take to recapture. You say, oh, great, I dropped my payment X amount of dollars, but then I spent X amount of dollars to refinance. And usually the break even is, if you can get 1%, difference, it usually cancels each other out. So can you refinance? Yes. But if you can't, or you don't, or the rate doesn't move, if you're comfortable now it's a quality of life question. Is everything lined up? Because that is more important than what happens with the rates. I hope that helps you with your question. Let's see. The cookies came out fine. Fantastic. Paul says, I'm selling, looking for rates to drop. Some more buyers are serious. Yeah, and I actually have, I got some more information to share with you about that and what might trigger some more buyer activity. So, they're talking about the rates moving next year, maybe staying the same this year. So why? Now we want to ask, okay, why is that? Where's that information coming from? Well, this article posted, earlier today. And this is some new Redfin data about a Fed cut, September rate cut. And there's a reason I wanted to talk about this, because of the information that is likely going to be coming in the news that may make this out bigger than it actually is. So September rate cut is cut likely as expected after July inflation report. It says mortgage rates will stay flat today following an as expected inflation report that keeps the Fed on track for a rate cut on September 17th. Inflation remains above target and rising, at least partly due to tariffs. But today's reading is not hot enough to derail a rate cut after the last jobs report. The expected rate cut is already priced into the current mortgage rates. We'll talk about that in a second. Core, excluding food and energy, inflation rose 0.32% month over month in July, in line with expectations, but still the highest reading since January. Overall, the impact of tariffs tariffs is evident, but the bulk of the impact still hasn't hit. Barring very unexpected data in early September, the Fed is now on track for a rate cut at their September 17th meeting. It's important to note, and this is why I wanted to bring this article up. It says it's important to note, however, that the expected rate cut is already fully priced into today's mortgage rates. That means mortgage rates are unlikely to move even when the Fed cuts occur, unless economic data necessitates more or fewer cuts. So if I jump over to where the rates are, this is where we are right at this moment. Today, 6.5%. You can see right where they jumped. So this was July 31st, 6.75. We were at, let's see, we're at 6.75, 6.875, about July 15th, and they bumped up 6.81, dropped a little bit on the 31st, and then between July 31st and August 4th, they dropped a chunk, and you can see that's a noteworthy drop in a short period of time of a couple days, and they bounced, and that's what they do. They bounce around. So right now it's at 6.58%. So what are they talking about in terms of that the Fed? And I wanted to, and I've talked about this before, but I wanted to get into it a little bit more granularly so that y'all can understand fully. So it says the expected rate cut is already fully priced into today's mortgage rates, or what you'll hear often the terminology is that it's baked in. It's the price cut is already baked into mortgage rates. Well, the reason they say that, and the thing that we need to keep in mind, is that mortgage rates don't react on the day of the Fed cut rates. They don't. Sorry. They often change ahead of time based on what markets expect the Fed to do. Lenders, investors, traders have already adjusted mortgage rates in anticipation of this September cut. In other words, mortgage rates today already reflect the belief that the Fed will cut rates. This happened last year. The Fed cut the rate in an entire point, and the mortgage rates had jumped weeks before. And this is exactly what happened. Why? Because the Fed rate is not directly connected to mortgage rates. The mortgage rates are based on investors, traders, what's happening with lenders. They watch what's happening in the market, and they react to the mortgage rate. The mortgage rate reacts to that, not the Fed. It says mortgage rates. The other thing they says, mortgage rates are unlikely to move even when the Fed cuts occur, unless economic, and this is that asterisk I was talking about, unless economic data necessitates more or fewer cuts. Okay, so what does that mean? When the Fed actually announces the cut, mortgage rates probably won't change much because the cut is already baked in. There we go. I could forgotten I put that in there. The only way rates would move is if new economic data before or at the meeting changes expectations. Like, if the data shows the economy is weaker than expected, the markets, not the Fed, but the markets might expect more Fed cuts, and mortgage rates could drop further. So we might see further drops if that economy data is weaker. It hinges on inflation. It says if data shows the economy is stronger or inflation is higher, markets might expect fewer or no Fed cuts. Mortgage rates could rise. So these are the things, when we're watching what might happen with mortgage rates, we're not necessarily watching the Fed. We're watching the economy data. We're watching the inflation data. That is what is going to dictate what happens with mortgage rates. So I hope this helps, clarify some things, because of the fact that we could, the rate has already dropped for the year. Now, what's going to happen going into next year? That's a great question, because again, what's going to happen with the economy, all the things. There's a there's a lot could happen between now and then. And anyone who says that this is going to, wait. And this is the thing, I forgot who said it in the chat. Wait, don't buy. Wait until the rates come down. I'd love to know who that person is, and I'd like them to buy me a lottery ticket, because obviously they know something that the entire economic world does not know. Um, let's see. Let me see what you guys got going on here. Let's see. Vicky says we almost have a 10 by 20 storage unit filled. We are continuing to pack things up. Yay! That's a win. That is a win, my friends. For sure. Thank you, sir. I appreciate that. Hit the like button. Let's see. Pistol Hour says, over the decades working in real estate, say the Bay Area, can a realtor relocate to Florida? Do you need to get licensed to work as a realtor in Florida? Yes, you do. So every state has its own licensing laws. So you would need to go through that process on what the licensing law is in Florida, and find out if they have, education requirements, so on and so forth, and get your license there. And there's a lot of agents that are licensed in multiple states. Let's see. Angie Madcat, good to see you. Says the lender told me they haven't factored them in yet this time. I know they did previously, and that's why they didn't adjust last time. As the kids say, that sounds very sus, Angie. If my kids heard that, their eyes would be rolling to the back of their head for sure. But you know what? They're not here. I don't believe that at all. Just because the economic data is it shows that it already has. So I'm not buying that. It doesn't make any sense. Skates 76 says, if the Fed doesn't cut the rate on September 17th or predicts fewer rate cuts later this year, mortgage rates could rise. It could, it absolutely, because even though they are not connected, they do have commonalities, right? Because the Fed doing something or not doing something, it does send, it is an influence over what investors will do. Because investors might, they'll look at the economic data, they'll look at the inflation data, and they make their own assessment, but they will listen to what the Fed's going to do as well, as a whole, because the Fed is reacting to these same elements as well. And so the rates absolutely could go up. I mean, how far? I don't see them going up. I'd be shocked if they went up over 7%, but anything is possible. Sandy says, your crystal ball's in the shop. We got Corey Rest in the house. Good to see you. Good to see you. I'm glad you're here. Yeah, Pop Life says, once we find the home we want, we will buy and not worry about the rate. Here's the thing. If you are an investor, if you are, this is a business, then yes, you watch the rates, because this is an investment. It doesn't matter as much about the house. You're not attached to the house. You don't care about the house. It doesn't matter, how much does it cost to maintain it, to update it, fix it, all the things. That's all investors care about. But when it's your home, when we're in a market that is low inventory, and picking, you know what, even down in the southern states, yes, their inventory is pre-pandemic levels, but you know what, pre-pandemic levels were not as high as the healthy market of several years prior. There's still much more inventory that needed. And and truthfully, if the market does adjust enough to entice those buyers to come out in the southern states, that inventory will be sold. I can guarantee this coming winter, during the height of the busy market during Florida, Everyone says, oh, nobody's buying properties in Florida. Go on Zillow and see how many sold this month. It's not zero. It's not zero. People are buying. People are holding off because they're wondering what's going to happen. But if all of a sudden things start shifting in the buyer's favor, they're going to come out and then it's going to be back to, leaning towards where we were before. So the name of the game is, if you find the right house, it's your home. Why would you wait? Why would you wait? Angie, thank you so much. I'm trying to find.
Really?
I just appreciate you saying that. I'm cool in my own head, my own mind. The other, let's see. I wanted to touch on, speaking of Florida, there is in the mortgage conversation, there has been a lot of conversation about underwater mortgages and foreclosures and short sales and all the buzzwords that were so big during the great financial crisis. It is a lot of it is without proper merit and research. Okay. And I wanted to kind of talk about that just a bit with you guys, just to shed some light so that, again, so you can understand what's going on. Because there are pockets that are struggling. There's no question. There's pockets that are struggling, but it is different. It's different than the great financial crisis. There's no comparison. If I see another headline, 2008 all over again, I think I'm gonna pop a cork. Like it's kind of silly. I get it. Headlines, sensationalism sells, and all the things. But this data came out today. This is off of Fast Company. And underwater mortgages are climbing in Florida and Texas housing markets. Negative equity is rising in some pandemic boomtowns, yet is nowhere near 2009 inventory. So underwater mortgages, in case you don't know, it just means that you owe more than your property is worth. And it says that since the pandemic housing boom fizzled in the summer of 2022, some overheated parts of the country, particularly in the west, southwest, and southeast, have experienced home price declines. And while many of these markets have seen only modest drops, a few metro areas, Punta Gorda, Florida, Austin, have undergone what this author has considered over at Fast Company material home price corrections, falling 18.6%, 23% respectively from their peaks. These regional home price declines raise the question, how many mortgage borrowers are actually underwater? Here's the thing. You know how when remember if you have kids and, remember back when, if they, depending on how old your kids are, when they were teenagers and they come in the house, Mom, there's nothing to eat in this house. There's nothing to eat. I say, well, what do you mean there's nothing to eat? Well, we'll open up their fridge and, okay, then I need to go grocery shopping. But there's something to eat. Oh no, there's not. There's never any food in this house. Remember those days? I feel like this is the same thing. Oh my gosh, there's underwater. There's so many homeowners underwater, and everybody's foreclosures are crazy and blah blah blah. Well, how many are we actually talking here? I think everything gets blown out of proportion because it's dramatic. And it says, meaning, how many mortgage borrowers are actually underwater, meaning their house is worth less than their outstanding mortgage balance right now. So Resi Club teamed up with ICE Mortgage Technology, formerly known as Black Knight, before it was acquired by Intercontinental. Yeah, ICE is not what you think. This is Intercontinental Exchange. It's a mortgage technology company, data company, and it says 1%, the share of outstanding homeowner mortgages with negative equity at the end of April 2025. One is the loneliest number. Sorry. 1%. 1%. Well, how is that? To give you some comparison, to make it relative, 23% was the share of outstanding homeowner mortgages that had negative equity at the end of September 2009. The great financial crisis, 23% versus the number now is 1%. Yes, it's all over the news. Yes, it's all over TikTok and all the things. People are crazy with their housing payment being unaffordable. Housing payment includes homeowners insurance, it includes HOA if you have it, it includes taxes. Those things have absolutely gone up because they are adjusting for the higher home values. But when you're talking on mortgage rates, when you're talking about mortgages foreclosing because they can't make their mortgage payments, and so oftentimes, I've seen this happen where they're getting these two terms mixed up, and you're seeing in the news, my mortgage payments, I've gone through the roof. They've gone up 50%. They've gone up 100%. What they're actually referring to is their housing payment. I get it. It's become absolutely, I am not denying the fact that it has become very, very tough for some folks that were not expecting that increase in payment, but it's not their mortgage payment. As long as they keep making that mortgage payment, they're not going to get foreclosed. Okay. This is the data. 1% versus 23%. It says, why on a nationally aggregated basis are there still not as many homeowners underwater despite home price declines in some markets? And the reason is nationally aggregate home prices are still pretty close to all-time highs. While many pockets of this west, southwest, and southeast have seen home price decline over at least some from the peak, nationally aggregated single-family prices are still pretty close to all-time highs. Amortization of ultra-low mortgage rates. This was another biggie that's different than from 2008, upwards, downwards, sideways. It says many homeowners locked into ultra-low mortgage rates during the pandemic housing boom with fixed rates around 2 to 3%. These monthly payments included a larger proportion of principal repayment from the start. That means borrowers have been paying down their balances more aggressively than they would under higher rate loans. If you're paying less, if you have a mortgage payment and it's $2,000 a month, if you're paying less interest, that means the rest of it is principal. You're paying down your mortgage faster because you're paying less in interest. It says as of Q4 2024, 54% of outstanding mortgage holders have rates below 4%, which has helped some borrowers build equity faster and give them a greater buffer. Here's the thing. During the great financial crisis, one of the things and one of the reasons why people got underwater during 2009 is when they purchased prior to the market crashing, they purchased with really low adjustable rate mortgages. The adjustable rate mortgages adjusted. They adjusted, and they adjusted after the bottom fell out of the market, and people were panicking. Their rates now, their mortgage payments went through the roof. I mean, I did more short sales, which is when you work with a bank to, basically convince them to accept an offer that is lower than what you owe. And yes, it's a ding on your credit and all the things, but it's better than foreclosure. That process is a nightmare. I had one that lasted 18 months. We went through 3 buyers, and 18 months later, we finally closed. It was a siege, and that was not unusual. It was awful. This is not happening. Why? Because people got 2 to 3% fixed rate mortgages. They didn't have 2 to 3% fixed rate mortgages during the great financial crisis. They had adjustable rate mortgages, they had balloon mortgages, but they didn't have fixed rate, not at that rate. It says, and finally, it says few buyers actually purchased at the peak in correction markets. And this was interesting. I had to think about this for a second, but I do agree with it. It says even in boom to correction markets like Cape Coral, I almost said Cape Coral. I don't want to get lashed out on this. Cape Coral, Florida, Austin only had a small share of homeowners bought at the absolute top of the market in spring 2022. Most current homeowners in those areas either bought before or after the peak. Think about it. There's only one peak. And a lot of folks, I bought at the top, I bought at the top, feels maybe like you bought at the top. Chances are you probably didn't buy exactly at the top of the market. It says this limited exposure at the peak helps explains why negative equity so far hasn't been a big problem, even in some of the hardest hit metros. While only 1% of outstanding U.S. homeowner mortgages have negative equity, there are a few pockets. There are a few pockets where it's getting close to 5% or even slightly crossed it. So I just wanted to show that real quick. It says these among the 100 major metro areas. These 15 have the highest share of homeowner mortgage. Has the highest share of homeowner mortgages currently underwater. So we've got Cape Coral 7.8%. A lot of Florida and Texas. We've got Lakeland in Florida at 4.4, San Antonio 4.3, Austin 4.2, Northport 3.8, Jacksonville 2.9, Baton Rouge, Louisiana, I used to live down that way, 2.8%, Palm Bay 2.7, New Orleans, Deltona, Tampa, Colorado Springs, I was surprised by that, 2.3%, Little Rock, Arkansas 2.2%, Dallas 1.7%, and Oklahoma City 1.6%. It says even in markets like Cape Coral and Austin that have slightly higher shares of outstanding homeowner mortgages that are currently underwater, that's still far from the levels seen at the height of the great financial crisis era bust. For comparison, back in September 2009, a staggering 68%. It's so important to look at history. You have to look at history. You cannot look at face value, even though it feels awful. It is awful right now. It is hard. Groceries are expensive. Everything is ridiculously expensive. It's hard not to. It's hard to look back and say and think, how can this not be on a collision course with with a bad destination? But we have to rely on data because sometimes our feelings will deceive us. And it says September 2009, a staggering 68% of mortgage borrowers in Nevada, 48% in Arizona, and 45% in Florida were underwater. So food for thought on this because of the fact that there is so much conversation. Could this get worse? Of course it could. Again, depends on the economy. Depends on what happens with the employment. It depends on what happens with inflation. Employment numbers are not good. They're not good. I know quite a few people that just cannot find a job. It is not good out there in that respect, and that will not bode well for the overall economy. So, all right. Oh boy, the chat. Let me get to the chat and see what's happening. Oh, goodness. Let's see what kind of questions you have. Let's see. Tracy says, hey, Tracy, I'm looking at a home that states it's protected by historic covenants. What does that mean? Can't upgrade. Great question. So, very familiar with this. Living in historic Plymouth, Massachusetts, we have quite a few historical areas. What that basically means is there is going to be a historical society in your area, in that particular town, that's going to govern what can and can't happen to the house. It is not all the same. You really need to check with them to find out what the limitations are. Limitations would be, anywhere from the color of the house that you paint. It could be the type of windows that you replace it with. What they're trying to do is preserve the historical nature of the house in that area. There's some sort of historical significance, for that area, for that neighborhood or whatnot, and they want to preserve it. But it means different things in different areas. Some are much stricter. I mean, we have some areas that you can't even change the doorknobs because it's it has historical significance. Others, you can't even change the windows. You have to reglaze the windows. You can put storms on to protect for insulation, but you cannot change the actual windows. You can't put in fancy updated windows and so forth. you've got to check. So I hope that that's a great question, and I hope that answers that shed some light. Um, yeah, Jay says, see how Canada does with their rate. Canada moves faster than the US. So the Canadian market, real estate market, and how their interest rates work is entirely different than the United States. They do not have a 30-year fixed mortgage. They don't. It fluctuates and flows with the market, which I can't fathom. I cannot fathom. Um, I get locked into a fixed rate mortgage at a low rate, and I have that rate for as long as I want to hold on to it, regardless of what happens with, the economy. And that's not the case in Canada. Not the case. Um, let's see. Joanne says, really enjoyed him at where as well. Watch from the beginning. Yes. Well, thank you for being here. I really appreciate it. Emmett Joy says Denver's down 9%. Yeah, Colorado is very interesting. Very, very interesting. Um, David Matney in the house, coming in from Omaha, Nebraska, 2008 all over again. Housing crash imminent. Good grief. The sky is falling. The sky is falling. Good grief. The sky is falling. There, I said it. It's not falling. um, Oh, Angie, this is such a good comment. Oh, yes. Doesn't matter if you're underwater, if you don't plan on selling, just stay put. Thank you, thank you, thank you for saying that. Because here's the thing. I often say this to my kids all the time, but I believe in this with all my heart. Worry is a waste of energy. Doesn't change anything. You cannot predict the future. You can't change the past. You can only be where you're at, and worrying about what may or may not happen is a total waste of energy. Number one. Number two, if you're not planning to move, if you're not planning to sell, why worry about it? Why worry about it? The market ebbs and flows. The market is a moving target. The real estate market never stops. It'll go up, it'll go back down. If it goes down, guarantees I would stake my life on it. It's gonna go back up again. It's just a matter of when. Now, if you're under time constraints, if your short-term goal is I need to move in the next year, 2 years, then what you want to do is you want to start taking a good look at what financially makes sense for you now. But if you don't need to move, I often have that question, and people get worried and everything else. And I say, well, are you planning to move? Well, no, but I'm losing money. You're losing money you never had. Equity equity is not real. Equity is not real. You cannot take it physical cash, see it, touch it, spend it. You can take a loan off of it. You can withdraw it. And it's a loan to pay it back, or sell the house to pay off the mortgage. But it's not real until you take it out. You didn't lose anything you don't have. Think about that for a second. You're not losing anything you don't have. So again, if you're thinking about selling and moving in the near future, different story. But if you're not planning to, yeah, you know what? A lot of folks were underwater at that point in time. Not a fun time, but it's patience, getting out of that. I had family members that were in that position and just wait it out. And you know what they did? And everything worked out A-okay. Let's see. We've got some chatter. It looks like MHO is asking David where a good place to eat is in Omaha. I hear they have steaks up there. Yeah, cactus also I feel for people underwater. Yeah, it doesn't feel good, but again, if you're not planning to move, for crying out loud, don't look at your mortgage value. Don't look at your mortgage statement. Don't look at your property value. Just don't look at it. That's what my feeling is. If you're in a 30-year fixed and you can afford your payment, put your head down, go about your daily business, go live your life, revisit it at a future date. Chuck says, hit the like button and Oprah. will will buy you a house. Oh, if only. If only, if only. Yeah, adjustable rates are scary. I think that adjustable rate mortgages have their place. And the reason I would say that is if you are in a 5-1 arm, say for example, where you have that fixed rate for 5 years and it's going to adjust, and you're planning to sell in the next 3 to 5 years, then it doesn't. Then you can take advantage of a lower rate, and then get out. Period. Get out. I think that there is some strategizing with that. However, the thing that you don't want to do is buy a house with the only way you can afford it is by getting an adjustable rate mortgage. Please don't do that. Please do not do that. You got to look at the worst case scenario. If you're sitting down with your lender and they suggest an adjustable rate mortgage and the rate looks really good, number one, please, please, please look at the APR. The APR is going to be your adjusted rate. It's going to be the rate of the closing cost plus of what the loan actually cost you plus your mortgage. And then they're going to factor that and give you a rate based on that combined number. And it's going to be higher. Your adjustable rate, your APR rate may be higher than another program that from the surface looks like it's a higher rate, but they have lower closing costs. So you've got to look at that APR to have like an apples to apples comparison. But if your lender starts talking about adjustable rate mortgages, oh, just be very careful. Read the fine print. Really look at your situation to see if it makes sense. I will never tell someone that these are not for everybody. They're not for anybody. Nobody should be doing adjustable rate mortgage. I think absolute mindset is a mistake. Having an absolute mindset on anything is a mistake. Why? Because everybody's different. Every situation's different. Every situation's different. Every person, every goal, everyone's gauge of a level of risk tolerance is different. So you've got to take that into consideration. Um, I'm MHOI says I did the arm in 2005 and skated through the whole thing. Oof. Says Clark says I'm not a fan of living. I'm a fan of living below my means, but I know everyone can't do that. I've talked about that for sure. I think that in itself, Clark, is going to be the thing that you can do to protect yourself heading into the end of this year, next year, across the board, in terms of insulating yourself against the economy. I know everybody's going crazy with the tariffs and buying stuff, and we got to buy it before the tariffs. We got to buy it before the tariffs kick in and all the things. Can you afford it now? Can you afford it now? If the answer is like, well, kinda, well, then who cares what the tariffs do? The tariffs may not do anything. The tariffs may not do anything. Again, worry, wasted energy on something that hasn't happened yet. But if it hurts your wallet, I would as they call, like, there's a term that we heard about when the wildfires were in full swing in California, and a lot of homeowners didn't have insurance because either they lost their homeowners insurance, they didn't have a mortgage, so they don't, when you have a mortgage, you don't have to have homeowners insurance, and so a lot of homeowners self-insured. They self-insure. What does that mean? That means that instead of paying an insurance company exorbitant amount of money a year for an insurance policy, they take that money, put it in a bank account, and if something happens to their property, they're going to pay for it out of pocket. Self-insure. I think you need to self-insure your personal economy right now. I really do. I think save, save, save. We got to get back to, yeah, make America great again. What I'd like to see is make America save again. Like we got to get back into the full swing of savings. Which, by the way, did you know savings rates are like up over 4% right now? Seriously, a regular savings account. I don't want to digress, but I mean, if you're not getting at least 4% on your savings account, leaving money on the table. Seriously. So many good deals on savings accounts right now. Um, mm, 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 mm. Let's see. Angie says, two of my friends lost their homes during two pulling out money constantly for stupid things. I think, Angie, what's going to happen, I think that potentially could cause chaos and get people underwater, not because of the mortgage that they took, not, or whatnot. It's because like the tying those two things together, if you're not living below your means, and now you need money to support your lifestyle, you don't want to adjust your lifestyle to your current situation, then you start looking for money. And you say, well, I've got a couple $100,000 I can tap into in my equity. I'll use that. That's when you get in trouble. That's when you get in trouble. The hardest thing that anyone can do, and believe me when I tell you that I have been self-employed for 30 years and not having a regular paycheck every week, every other week. I learn how to budget, and there's been hard times. I've had some hard times. I've had some more comfortable times. And the one thing that carried me through is learning how to do without. Learning how to do without. Arms and legs are not going to fall off if you cancel streaming services. Just saying. Your arms and legs are not going to fall off if you drive a used car. Just saying. Just food for thought. Angie says arms can be good. Sorry, I got to do it. Yes, they can. I'm a dork. Arms can be good if you understand how they work. There are some good ones out there right now. Yeah, 100, and that ties into what I was mentioning earlier. Doing your homework and looking at your situation as a whole. Anime choices. Funny thing is I should have stayed put for a while since the LIBOR went down. Well, coulda, shoulda, woulda. Can't go backwards. Can't go backwards. Clark says, I know a friend of mine who has been looking for a job for a year and a half, qualified but just can't find a job. That like blows my mind. It blows my mind because, and I don't understand. I do and I don't. There's supposedly hundreds of thousands of jobs available, but yet there aren't any jobs. Why? Oh, because the jobs that are available don't pay enough to support an average American household right now. The numbers don't always tell the entire story of what's happening in the economy. Because even though there may be jobs available, it doesn't necessarily mean they're suitable to live. And asking someone, yes, live below your means, but asking someone to pick up and move from an area that they raise their kids in, that their friends are in, that their family is in, just to survive, that's hard. It's doable, but it's hard. Let's see. I'm just gonna make sure I get to your questions. Let's see. Dun, 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 dun. All right. Sandy says the stock market doesn't think the sky is falling. It hit an all-time high today. That's something to watch because that might be an indicator. Depending on what happens in the stock market, you're looking at that will trickle down to affect what the investors do. We could see the rates react in the next couple of days. We'll have to watch that because the rates could start trickling upwards because of it. Pissflower says, by the way, your avatar looks like one of my when I was growing up, we had a household cat named Morris, and he looks just like that. He used to look just like that. But anyways, Morris the cat. Thanks so much for the info here in Prescott. Area groceries can be insane. Even the turkey sausage is skyrocketed to $5.99 a pound. Oh my goodness. Oh my goodness. You know what? Turkey, pigs are flying. What's that Ghostbuster references? Bill Murray, I forget what he says now. When he's in New York Pigs are flying. I don't know. You guys, you can jump in the chat. Tell me what I'm thinking of here. Um, let's see. We got, Lowell Larson here, California. Good. Another California person. Make sure you're stocked up on toilet paper. Yes. Oh boy. I don't want to ever go through that again. Yeah, or better yet, buy a bidet. I helped a buyer purchase a house a couple months ago. The seller took the bidet with them. No joke. They took it was in a disclosure and everything. They took it, they disconnected it and took it with them. So what the heck? Give me a break. I was like, what? Oh my gosh. Skate says, I had a construction loan coming due and getting an arm from a local bank saved me as Fannie and Freddie won't issue a mortgage without molding. So that is a great example of using an arm in the correct way. You're using it as a bridge, more or less, right? It's just a carryover. You probably refinance after everything's done to, into a 30-year fix. But for the time being, it's going to carry you over. And that's strategy. Let's see here. Oh my goodness, is that the Katie Lance? This is my good friend Katie Lance from California, IA. Good to see you, my friend. How are your kids? Boy, your kids are getting big. Big, big. We haven't talked to you in forever. Forever and a day. Let's see. Pistol Hour says, that is what my brother told me not to take the equity out of the house. Please do not touch your equity. If you're sitting on a boatload of cash right now, honestly, the only asterisk I would say consider that you could consider doing it, using that equity for is to improve your home. Improve your home. So anyway, in other words, if you're going to do a renovation that's going to improve their overall value, then I say that justifies taking equity out because you will make that up when you go to sell the house, your overall home value. But don't take it out to subsidize the way you live. Don't take it out for student loans for your kids. Do not. Oh my goodness, I can't tell you how many parents I know did that. Don't mortgage your house. Sorry, kids. My feeling is, and you know what, and hey, if you're a parent that did this, I'm not gonna judge. Everybody does the thing that they feel is right. My feeling is it's their debt. It's their life, their education. Skin in the game. Skin in the game. My older daughter that graduated from college last year, she was very aware of how much the college cost. And I don't want to go down too much of a rabbit hole here, but I'll just say that it's very timely given that where we are, a lot of kids going off to college very, very soon. We had this conversation about what's going to cost for college and how, what the end result is. And she knew that, yes, I'm co-signing, but they are going to be her responsibility. And so she was very careful when we sat down and thought hard before saying that's the college I want to go to. And I will tell you, while she was there, she sucked the marrow from the bones of that school because she says, I want to get my money's worth. She's an artist. She graduated Bachelor of Fine Arts, summa cum laude. Very proud of her. And she was the first one in the studio and the last one to leave and still maintains contact with her professors and all the things. Skin in the game. I think that my financial advisor told me that. My financial advisor says, don't pay for your college loans. Let the kids pay. They're going to be on this planet a lot longer than I will. They have a lot more working years coming ahead. So just my side commentary. D says, good to see you. Doing without gets easier as we age. We hope we age and we grow wiser, maybe. We learn that we don't need as much, and a minimalist lifestyle becomes appealing given less stress. Thank you for that. I agree. Even though I do love gadgets and all the things, but I'm more careful with what I buy. I'm more careful where I put my money. and tend to put my money more into things that are an investment in me. Like I bought a mattress. Holy cow, I didn't realize how much mattresses cost. But nothing says nothing more important than a good night's sleep. Yeah, MHOA, you bring up a good, this is also fake job listings to boost the stock companies under the guise of their growing. Here's the thing, and I saw this happen last year. This happened last year where the job reports came out, and obviously that has an impact on what the Fed does. It has an impact on what's happening in the overall economy. Then they recanted and said the numbers weren't 100% accurate. And I believe it was all intentional. I believe it was 100% intentional, because they wanted to influence the economy a certain way. So, not to be like all tinfoil hat and all the things and, don't believe the government. Everybody's lying. I don't want to say that. I don't believe that. But I do think you need to question everything, because yes, you are correct. Yeah, Chuck says we need a living wage for all. I agree. Oh boy, Gigi's comfort food. What kind of comfort food are we talking? I'm always good for ice cream. My daughter-in-law is working. My son has been looking for a year. Wow. I'd be curious to know what line of work that he's been having a hard time getting work in. Potpourri of Life, my credit union shared I could do the ARM fixed 10 years so that once we sell our current house that is paid, we can then pay off the new mortgage with no penalty. That is exactly what I'm talking about. Strategy. You're using an ARM for strategy, not as a means to purchase the house. It's not the only way you can afford it. You're doing it smartly. Like, for example, I just mentioned I bought a new mattress. I could have paid cash, but I didn't. Why? Because they had a deal at the mattress store that says if I opened up their financing, credit card, whatever not, which of course I'm going to cancel right away, they have no payments for 6 months, 12 months, whatever not. I didn't really care about that. What I cared about was the 3% cash back, which was better than the 1.5% that I was going to get on my Citi card, which is what I usually use. So I'm going to get 3% cash back. So I'm still going to pay that off. It's the same as paying cash, but I'm using credit to my advantage smartly to make money in my favor. That is what you're doing. And I think that's super smart. Super, super smart. You just got to be disciplined. This is the big thing that is the hardest part for most people is the discipline not to abuse it. Pistol Hour says, I drive for Lyft, Uber, and creating the Pistol Hour, but now the driving gig is not working as well lately. Interesting. I wonder why. Fabiano, how you doing, my friend? Coming in from New Hampshire. Marilyn and her husband are amazing. I'm so happy I connected Fabiano up there with one of my referral partners, and I did get your email, Fabiano, and I was getting ready for the live stream, so I didn't have a chance to respond, but I'm so happy. I'm so happy that is just, yay! That deserves a little round of applause. I'm so happy that's working out great. Yes, the stock market is not an indicator of how the working class people are doing. Amen. Amen, amen, amen. Let's see. Yes, Katie. Oh my goodness, 14 and 17. How is that even possible? Yes, we do need to chat, my friend. I'd love to catch up. Oh, Carol. Yes, sold her house. Woo! Fabulous. Now considering a condo in St. Paul, Minnesota. How to judge the HOA trust an agent to keep away from bad HOAs. As a 20% agent, have good info, or is there a lot more digging to do? Both. So here's the thing. A good agent is going to give you data. A good agent may have an inkling. They will be able to get the biggest thing you can do with an HOA. The most beneficial thing is you've got to get the financials, preferably the further back you can go, the better. So I say at a minimum 2 years, but if you can get 3 years or more, of the past financials, you'll be able to see their track record. Have they had, how much reserves do they have? What's their expenditures? Based on the age of the property, do they have budgeted repairs? So, for example, you have a condo building that was built in the 80s or the 90s, and the roof has never been done, or the siding hasn't been done in 20 years. That's a red flag. That's an expense that will come up while you're living there. And if they don't have that budgeted in the current budget, that's a problem, because that will be an assessment that's going to creep up. But you've got to get the financials, and then you got to get a copy. And this is what a 20% agent will be able to do, is get you that information, in terms of, the master deed and the rules and bylaws and whatnot. But I do always, always encourage you to advocate for yourself. Spend some time driving through, preferably on the weekend when people are out and about. Talk to the neighbors, see what they say. Now, you do have to take it for, as with a as a grain of salt, I guess is what they say, because if you have one neighbor that's disgruntled, who thinks everybody's out to get them and hates everyone and whatever, you don't want to obviously base your opinion based on one person, but you can get a general gist and maybe get them to, spill the tea, as it may be. So it's a team effort. It's a team effort. But if you don't have that 20% agent or 10% agent, to help you, that if you have an agent that's just an order taker, that's where you get into, that's where I think a lot of folks got into hot water and spending more than they probably should. Okay, Gigi, I want to direct you to go to my channel. I have a ton of content on this exact subject. There are so many different things. It does depend on, your area and your age of your house and all the things, but I have done many, many videos on, things to consider, depending on when you're looking to sell. Here's the thing. There is, and this comes up in the comments on my content quite often, where there's a little bit kickback. The argument of money versus quality of life, right? Catering to the buyer versus what is it that I want. You have to weigh out what your goals are. You have to weigh out how long you're going to be there. If you're going to be in that house for 10 years, do whatever the heck you want to do. You want to renovate the kitchen? You got 10 years to enjoy it. You want to paint every room black? You got 10 years to enjoy it. Do whatever you want to do. However, if you're looking to sell in the next 5 years, I would not recommend doing major updates. Why? Because your house won't, especially in this market, it's not going to appreciate fast enough to cover what you spent on that renovation. And you won't have enough time to actually enjoy. I mean, I think that the enjoyment piece is worth something. That's worth a monetary value in my book. Just the enjoyment, quality of life. But if you don't have the time to do it because you're planning to sell pretty quickly in the near future, then you're wasting money. Now you go conservative and maybe just replace, door catches, door pulls rather, knobs and things like that to spruce it up. Not a major investment. Makes you feel good. You know what I mean? Paint is not expensive. It's a pain in the butt to paint, but it's not an expensive ordeal. But definitely dig into that content and then see how it relates to what your situation is. But thanks for asking that. Oh, thank you, Morris. It's funny. I was just talking about the cat in the Pistol Hours avatar. It looks like my old cat, Morris, growing up. I've been watching for weeks and love your show. Thank you, thank you, thank you. Selling in Dallas in March. We'll be reaching out for a referral. Fill out the referral form, and get the ball rolling. My referral partners do not care how long it takes. They're not transaction. Let me just explain. A transaction broker and a relational broker. The relational or agent, I should say, not broker, but a relational agent is there for you. They will advise. I had a call from one of my awesome referral partners down in Florida, and she said, Jen, I successfully helped talk a homeowner out of selling. And I said, you know what? That is why you're a 20% agent, because you're putting their needs ahead of your own. And the personal needs of the agents that I refer to, they don't. Their goal is what your goal is. And that may mean 12 months, that may mean 6 months, it may be longer. I had somebody reach out to me that was a couple of years out and said, I just need some advice on what I should do with renovations. And I connected her to an agent, one of my referral partners, and they're going to, advise her, give her support. There's no pressure to sell. Why? Because that's how we run our business. That's how I've run my business for 30 years. That's how I run my business. Value, provide support. The money will take care of itself. Pislar says, I left California. I won't ever take money out because I've been working off debt. So staying put and working towards a better career. Good for you. Good for you. Good for you. Oh, we got Polly Fox in the house. Still happy here north of Muncie, Indiana. Investors are selling their rental houses all around us. Really? Are private investors getting out of housing? Thanks, pal. This is a great question, and I have not dug into the data. I'll be truthful. There hasn't been a lot of hubbub with private investors. I think that it's entirely possible, but why would they do that? It would have to do with the rental market, right? If the rental market is having a challenging time, and if we think about it, it has been progressively. We have had tens of thousands of immigrants that have been escorted out of the country. A lot of them needed to go. A lot of them didn't. That topic doesn't matter. Neither here nor there. Doesn't matter. What matters is they were paying rent, and now all those rentals are empty. And these private investors, they didn't care who was paying them rent as long as they got the money. All these empty rentals, all these empty buildings, they're not making money. Dump them. This is the implications that unfortunately I think are glossed over. The ripple effects, the here and now. It's like let's get back to the ice cream, because I just love eating ice cream. When you're craving ice cream, you want that Ben and Jerry's. I love the Netflix and chill one with the pretzel and the caramel and all the things. When I'm thinking about having that, I'm like, you know what? It's the immediate gratification. It's like, oh, it tastes good and all the things, whatever. I'm not thinking about the fact that the scale's not going to like me in a couple days. Ripple effect. Not thinking about it. I'm like, I want it now. It's satisfying a craving. I'm sitting in front of the television watching my TV channel, blah, 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 whatever. I think a lot of that is happening in the country, in this administration right now. And I think immigration is one of those things. That's what I just think. I'm not saying it shouldn't happen. Things needed to happen to secure the borders. However, the ripple effect is being understated. I think rentals is one of those. I think a lot, and it's not just the investors, it's the small mom and pop landlords that are feeling it too. Because a lot of folks were escorted out of the country that were tax paying individuals, paying their rent. And now they're not. And who does that hurt? The investors will figure it out. Who cares about them? But what will happen is that the mom and pops, now they're under crunch time. Now they're under financial distress. That bothers me. That bothers me. To put Americans into, unnecessarily into hardship. We'll see what happens. Maybe the rental rates will come down and make it more affordable. We'll see. All right. Dun, 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 dun. Karen's a proud tinfoil hat wearer. Here we go. There we go. That one's for you, Karen. Let's see. MHWA says, I love my brother-in-law to learn a trade, and that way I'd know what kind of work he's out of. We need to get, and I've said this before, we need to get these kids back in the trades. Back in the trades. We need to get this. So there's, oh my goodness. Stop asking these kids where they're going to college and say, hey, do you want to make six figures? Be an electrician. We need more women electrician. We need more welders, plumbers, all the things. And they're making big money. Why? Because there's not enough of them. 30% of the trades workforce is going to be retiring the next 5-10 years. Gone. You think trade prices are high now? Wait. Just wait. Next time your pipes are leaking, just wait. The only benefit at that point is the home improvement stores when the homeowner doesn't want to pay the huge ridiculous bill from the plumber and says, I'm going to do it myself, and goes and gets the stuff from the Home Depot and tries to do it themselves and then calls the plumber. Yep, that's going to happen. Oh my goodness. So Skate says, and this actually brings up a good point. A HELOC is good for replacing a septic system or roof. Septic systems, I know up here in the Northeast, I have a septic system, and they can run like 25 grand. Don't want to take 25 grand. If I have 25 grand in my reserves at the time, do I want to empty my reserves to pay for the septic system? I'd probably use a HELOC to pay it, because it is a repair. It's not necessarily an improvement, but it does having an operational septic system is a good thing at the end of the day. Let's see. I never went to college and make over six figures. College today is a trap. I'll be fully transparent. I don't have a degree. Some of you know those some that are friends on the live stream, whatnot, I've told, but I dropped out of college first 3 months after I graduated high school, went to college 3 months, didn't tell my parents for a while, joined a band. I was in a band, I was a piano player, joined a blues rock band, 5 years, did that, thought I was going to be a rock star. We'll see how that turned out. And decided I got to get a real job, and here we are. Now it's 30 years later doing real estate. Yes, I've always done education. I did go to night classes and, did some degree classes. I have taken more real estate course classes to better myself than I can count, but I don't have a degree hanging on the wall. And my kids are fed. They're well fed. I'm well fed. Can you tell? I'm very grateful. So yeah, it not for everyone, but I think that, selling young kids on the only way to make a living is going to college is a trap. 100% agree. All right, just being mindful of time. Oh, I gotta make sure I look at the chat. If you guys have not voted on the poll, make sure you jump on the poll and see see what's popping. And I'm gonna close that poll out in about a second. Let's see. Yeah, this said a new mattress delivery. I squawked about the cost, even though it was on sale. It's my sleep, so I guess it's worth it. It's my only splurge of the year. I paid cash. So at least you didn't do what I did, D. So in Massachusetts here, we have a tax-free weekend coming up. Boy, it would have been smart if Jen waited to the tax-free weekend to buy her mattress instead of going and paying it, paying full price and not getting the tax-free benefit. Oh, boy. College doesn't tell you that, though. Let's see. Sandy says, get the meeting minutes for HOAs, 100%, so you know what's going on. Yes. God, you guys, I just love how you're chiming in. It's my favorite night of the week. I re-landscape the property if you win the lottery. Amen. My goodness. Yes, sirree. There we have it. All right, let's look at those. Let's look at that poll. So where do you think the mortgage rates will be by spring 2006? So we've got under 6.5 to 7%, 14% of you. We've got under 5.5%, 23%. We've got 5.5 to 6%, 27% of you. And the winner, 36% of you, predict 6 to 6.5%. I concur. I personally think that that's where it's going to fall. I think that we're going to be probably in the low, potentially low sixes. Could we reach 5% next year? Anything's possible. It's really going to depend. It's going to depend on, so many moving targets, so many different things. And we've got to keep an eye on that could affect the overall economy and how investors feel. But I don't think we're going to see, and I wouldn't bank on it. The big thing that I don't want you to do is I don't want you to wait for it. Don't wait for it unless you can't afford it. If you can't afford it, you can't afford it. Then don't do it. Then you wait. You bide your time until you A, have a bigger down payment, B, you're making more money, or C, the rates do come down to the point where you can lock in with 30-year fixed. But if you can afford it now, here's the thing. If you're renting and you're paying somebody else's mortgage and you can afford to buy a house and take on that responsibility, you have to figure in the cost, the carrying cost of the mortgage, the rent payments that you're going to lose. If you pay $10,000 over the next year towards rent payment and you waited until the rates dropped another 0.25% and you only saved yourself maybe a couple grand, which was the smarter play? You got to look at all the factors. It's all about the budget, my friends. It's all about the budgets. And on that note, I think I'm gonna jet here because you know what? It's that time of night, and my tummy's hungry. I'm getting a little rumbly in the tumbly. Rumbly's Mr. Winnie the Pooh says. Anyhow, hey, listen, we're gonna watch the rates. We're gonna see what happens. We're going to monitor as always. I will be back here next Tuesday, 6 p.m. Eastern, same bat time, same bat channel, and we'll have more updates as they unfold. I'm sure there'll be more. There's so many things, a lot of things happening, and it's not all the sky is falling news. Some of this stuff is good, potentially good. So, hey. Thanks for hanging out with me for the last hour and a half. I appreciate you guys. And be safe, be kind, check in on your neighbor. And as I always say every week, if you don't see eye to eye with someone, before you judge, seek to understand. Because asking some questions, having an open heart and listening to their side of the story, you don't have to agree. But just try to understand. You might find out that you're on the same page more than you think. Food for thought. So have a great week, everybody. Take care of yourself. I'll see you next Tuesday. Sayonara.